Hello everyone. Thank you for joining us today for the webinar on supply of goods and services under VAT. I'm your host Ashika and this webinar is powered by Zoho Books, cloud-based VAT compliant accounting software. Before we begin, please note that if you have any questions throughout this session, you can feel free to type them out in the chat box in the GoToWebinar screen. I have a team of panelists here who will answer your questions as we proceed with the presentation. Also, after this session, we will send you a recording of this webinar. This is our second in the series of webinars about VAT, and today we are going to talk about the impact of VAT on the supply of goods and services. I assume that most of you are familiar with VAT. For those who are still not very clear about it, VAT is an indirect tax that is levied on the value of goods and services. We call it an indirect tax as it's paid by the end consumers to the sellers of the goods and services, who then collect the tax and pay to the government. Now this session is divided into three main parts where we'll discuss supply, the types of supply, and the components of supply. Now what do we refer to when we use the term supply? Supply refers to the goods and services that are exchanged for consideration. We say that a supply has taken place when there is a transaction between two people, out of which at least one is a registered taxpayer. Now this includes buying goods to sell them, outsourcing a service, and importing and exporting goods. Purchasing, selling, and stock transfers are considered supplies even if there is no exchange of money. Next, we move on to the types of supply under VAT. They are broadly classified into three categories: standard rated supply, zero rated supply, and exempted supply. Other than these, we will also see more about out of scope supply, deemed supply, and composite supply. Exempted supply. VAT will not be imposed in some cases, such as residential rent and rent of housing for students and certain financial services. Zero VAT rate will apply to certain goods and services. Now this includes the exports made outside GCC, services provided under international passenger transport, using vehicles and equipment for international transportation, investment in certain precious metals with purity greater than or equal to 99%, and certain medicines and medical equipment issued by the KSA Ministry of Health. Now this brings us to an important point to be noted. Businesses involved in supply of zero-rated goods and services will not be entitled to claim tax on the sales, but they can deduct their input VAT and claim refunds for the tax paid on purchases. However, businesses involved in exempt supplies cannot collect VAT on sales, and they are not entitled to claim refund on the tax paid on purchases. Goods and services that are not included in zero-rated and exempted sectors will be grouped under the standard tax rate of 5%. Out of scope supply. When an overseas supplier or a non-registered person supplies goods or services to a person situated overseas, then it's considered out of scope supply. Now there are three main scenarios where a supply is considered outside the scope of VAT. They are: when the supply is made by a non-taxable person, when the supply is made outside KSA, when the supply is not made in the course of an economic activity. Say for example, certain government activities or supplies made with no economic benefit. Now this includes providing goods or services to a different department within your own business. Let's see an example to understand it better. Say there are two local businesses, A and B, that specialize in food products. Now A sells food products to B. These food products are then shipped directly from A's factory in Hong Kong to B's branch in London. These goods do not pass through Saudi Arabia, though the distributor is located in Saudi Arabia. So the sales of these food products is considered an out-of-scope supply. Deemed supply. On the whole, goods and services that are bought for business purposes but later used for private use or used as gifts or samples are known as deemed supplies. We can take the examples of printers here. Maria owns a digital print shop, so she has a printer which she uses for business purposes, and at times she uses the same printer for personal purposes. How should she handle VAT in this case? She has two options. She can either distribute the input VAT between her business and personal usage and later recover the VAT that was used for business purposes. Or she can claim total input VAT and make an output VAT adjustment wherever the printer has been used for personal use. Composite supply. When two or more goods or services are bundled together, it's called a composite supply. A composite supply includes a main component which is essential to maintain the purpose of the bundle. Now, can you think of an example instantly? You would probably be familiar with this. Airline service. When you purchase an air ticket, it often includes the cost of in-flight refreshment. So here, the air ticket is the main supply, as it wouldn't make much sense to sell just the food without the ticket. So these are the three other categories. If you have any questions, please type them out. We will also answer your questions at the end of the session. Paying VAT on imports. Imports are always taxable unless the product is otherwise specified as exempt. Both VAT registered and unregistered businesses are required to pay VAT on imports as described below. Registered businesses. If a business is registered for VAT and is importing goods from a non-GCC country or within the GCC but it cannot prove previous VAT payment, then the business is liable to pay VAT to the Customs Department upon the arrival of the imported goods to KSA. Net importers can apply to pay import VAT to GAZT in the same tax return as their other VAT. GAZT will primarily approve larger volume importers for this option. Unregistered businesses. If an unregistered business imports goods worth more than 10,000 riyals from another GCC state and it cannot prove that it paid VAT in the nation of origin, it is required to pay VAT in the kingdom to the Customs Department. The value of imported goods is the value of the goods plus any of the following applicable: customs duties, excise duties, insurance duties, freight duties, any other fiscal charges except for VAT itself, and any services incidental to the import of goods which is not included in the dutiable value. Exempt imports. The following imports of goods which are not subject to custom duties are exempt from import VAT. Goods used for diplomatic and primary use which are exempt from custom duties. Goods used for diplomatic and military purposes exempt from custom duties. Import of personal and household appliances into the kingdom which are exempt from custom duties in accordance with the Unified Customs Law. Imports of returned goods which are fully exempt from custom duties. Low value of imports of personal items and gifts carried in travelers' personal luggage within the limits set by the Customs Department for relief from custom duties collection. So with this, we'll move on to the components of supply. There are three components of supply, and it's important for you to know about them to claim your input VAT correctly and also to file your returns without any hassle. Place of supply. Place of supply is the place where the final consumption of the goods or services takes place, and it need not always be the same place where the supply was manufactured. We determine place of supply for a transaction to differentiate between domestic, intra-GCC, and non-GCC business transactions. Say, for example, a manufacturer in Jeddah has a store in Jeddah and they sell their supplies in Jeddah. Then the place of supply is Saudi Arabia and they are liable to pay VAT to GSGT. So based on your place of supply, you can determine whether VAT is applicable on the transaction or not, and if it is applicable, you can determine the rate of VAT that is applicable, which is 5%, 0%, or exempt. So this is the basic rule, and it always applies unless overridden by a special rule. So there are certain special situations for which the place of supply is determined on a different basis. Real estate services. If a business registered in Saudi Arabia provides real estate services outside the kingdom, the place of supply is the place where the services are received. Wired and wireless telecommunication and electronic services. In this case, the place of supply is the location of the recipient unless the customer is paying to use the service at a specific location, like an internet cafe or a hotel. Services related to passenger and goods transportation. In this case, the place of supply is where the service is performed. If the service is performed in multiple countries, then VAT is calculated by proportionally dividing the value of the service with respect to the magnitude of service performed inside KSA and the amount of service performed outside KSA. Goods supplied after import. If a KSA-based supplier is selling a product to a KSA-based customer but needs to first import that product from outside the kingdom, then the transaction is split into two parts: the import transaction and the domestic supply transaction. The place of supply for the domestic transaction between two KSA firms is KSA. Cultural, artistic, sport, education, and entertainment services. The place of supply for these services is the place where the service is performed. Businesses registered in multiple countries. In some cases, a customer might be registered for VAT in more than one GCC state. In this case, VAT paid or collected on each transaction should be accounted for pertaining to the country most closely associated to the transaction. Say for example, let's say a KSA headquartered manufacturer has factories in both KSA and the UAE. If the manufacturer fulfills a purchase order for a customer in Europe from its factory in the UAE, then the sales should be noted on its UAE VAT return rather than its return in KSA. Next in line is the value of supply. Value of supply is simply the amount collected by the supplier for the supply of goods or services. Now this includes the expenses and charges like shipping and handling charges. The value of supply is its fair market value instead of any actual consideration paid in cases where each of the following applies. A supply is made between related persons as defined in the agreement or the regulations. The consideration for the supply is less than the fair market value of the supply. The customer is not entitled to a full input tax deduction in relation to the supply. One last component of supply is the date of supply. It's also called the time of supply. The date of supply for a transaction is the date on which taxes are levied on the goods or services that are supplied. As a general rule, though some exception is applicable, tax is due on the earliest of the three following dates: date of supply of goods or services, or date of issuing a tax invoice, or date of receiving partial or full consideration and within the limit of the amount received. Special time of supply rules are applicable in cases of continuous supply, installment payments, supply of oil and gas, supply of water and electricity, and deemed supplies. With that, we come to the end of this webinar. We hope that you've enjoyed this webinar and found it productive. We will have more webinars in this series, and you can find more resources under VAT resources on the Zoho Books website. You can follow us on Facebook, Twitter, and LinkedIn for more updates on VAT. And in case of any queries, feel free to contact us at support@zohobooks.com. Thank you.